Mark Newton is with us, the president and founder at Newton Advisors. Mark, a lot of this has been concentrated in the NASDAQ, but let's just start with the S&P 500, the key benchmark here for the overall market. How ugly is the breakage? Are we reversing trends, slowing down bull trends? How do you characterize it?
Thanks, Oliver. Yeah, I hope you had a great Labor Day weekend. So I do view the damage as being important and negative. I think markets likely are turning lower for the period of at least 4 to 6 weeks into late October or even the election before we can bounce. How you play it really depends on your time frame and risk tolerance. Some might look from a trading perspective to buy into declines this week and look to, play the bounce and then short it. For those that are with a longer term perspective, it's likely that, this can extend lower over the next month or so. And so my thinking is we can get at least down 15%, potentially 20% down between now and the election. A lot of really important reasons as to why this could be happening now, just starting off initially with just being overbought, and the markets had run up about 60%, a very historic run, the largest at least since the late 1930s. And so after, a 7% August, this is a much needed wake-up call, the real shot across the bow, I think, for investors. You spoke about the concentration. I think that's very important. We saw, S&P at new all-time highs. We only had 30% of all those stocks actually hitting highs above January, February. So that's important. Those had an average market cap of about 140 billion, whereas the majority, the other 70%, certainly far below. But we did see some recent momentum and breadth deterioration, and I think a lot of us were waiting for that real trigger, that real catalyst, and that seems to have happened last week. So we did break uptrends, at least going back since June on S&P and NASDAQ. You saw a breakdown of equal-weighted technology to the broader market as well, and I think that's really important. Even with Apple's split, technology is still, over 20% weighting in the S&P. So, the question many people have is is this just rotation, and can we avoid a larger September swoon, or is it something where the whole market has to sell off? And so, largely this has been concentrated on technology on the way up, and then the last few days a lot of it's been technology on the way down, and a lot of this so-called reopening trade has acted very, very well and really held up thus far. But I'm seeing this likely providing a sell-off into mid-September and then a bounce attempt. And then you really want to be selling into it likely post-September election into October. That should be really the meat of the decline, so to speak. And I take that really from a lot of cycles that I look at, looking at a 3 composite cycle that have been most accurate in the S&P over the last 5 years. And those all turn pretty sharply to the downside, over the next few weeks, particularly from late September into October. So that's the time I feel should be the most volatile. The next couple weeks, it could be choppy, certainly more volatility, and how you approach it certainly just depends on your time frame.
So, Mark, just to come back to literally like the second thing you said, which was 4 to 6 weeks potential downtrend, is there something technically that's setting up that calendar for you? Or are you just saying, hey, between here and the election, a big unknown, that's kind of what your gut tells you?
Yeah, a lot of the cycles I look at suggest late October, and then there's something else that suggests the early part of November. So that's just a common area where if markets are down a lot since then.
Okay.
We'll have to look at it in terms of how far we've gotten down, what sentiment is like after the decline. And if we're really fearful heading into the election, that might be a time to consider buying dips, specifically in December. But, between now and then, I just think we're going to see some volatility.
We're looking at a chart at the S&P with the trend that what looks like maybe is breaking right now, MACD on there as well. Are there certain areas here that look like short-term support or places where, people can find an opportunity to get out? Are there areas you expect there to be some help in this potential downtrend?
So with specific levels, I would argue for those that are very short-term in nature, you can simply look to last Friday's lows. We're basically testing that. If we can hold that and try to close positive for today, that could be short-term support. But under that level, I would argue S&P has downside to right around 32.29 or so, which would be between a 50 and a 62% retracement of the move up since late June. And so there's a lot of things around that area so it's only about 3 to 4% lower initially. And then when people would look to play the bounce, In terms of sectors, though, I think the defensive sectors make a lot of sense to me here. Utilities and staples look attractive, relatively speaking. I think energy, however, really starting to roll over. And one interesting thing is you're seeing that positive correlation yet again between crude breaking along with the equity indices, which had not been in place for some time. So a big breakdown in WTI and across the energy space, which has just been unfortunately the big whipping boy for the market for some time. And I still think that's going to be the case in Q4. I think energy will underperform and we'll see a larger sell-off in WTI crude.
Okay. When we look at volatility metrics, Mark, let's shift over to VIX, or I know you also watch UVXY2, the ETF. So where are you looking here? I mean, is this going to be a rising vol environment? We saw an interesting couple weeks there where vol was creeping up, even as stocks were creeping up.
Yeah, the correlations actually went pretty positive and sort of front ran the actual break in the indices themselves. And so that was interesting. And the VIX was rising for a period of a couple weeks, and many people looking to play sort of a low and vol probably missed it. But for now, I think you want to use any sort of pullback in the VIX as a chance to buy implied volatility and choose your poison in terms of how you wish to play it with the ETFs or VIX futures or buying VIX calls or just shorting. I think some of the small caps and buying puts on things like IWM. I mean, there's a lot of ways to go about it. We did see a pretty pronounced downturn in small caps versus the broader market again just a couple weeks ago. So I think small caps lagged again on the downside. So volatility. Implied volatility really never got down to the levels we saw back in February, as many would note, implied volatility at that time was single digits, even right around 11, 13 on the VIX. And this time I think we troughed at around 20 and then turned back up pretty sharply. So, I still think that's an attractive way to play it. I think that there's going to be a lot of uncertainty, and the key is to really focus in on sentiment and the level of fear that happens on this sell-off. And does it become, pronounced very rapidly where one would want to consider trying to trade it? But for me, I like being long vol through the latter part of October. I'll just look to buy dips.
Now, you mentioned the small cap, the Russell performance is being shallower to the downside. Of course, everybody knows it was shallower to the upside too. But do you see that relative strength right now as actually being something compelling? Strong? Does the Russell chart look better than the NASDAQ? Is this going to actually work in your opinion, or is it just a less bad place to be?
Well, I've seen both mid caps and small caps start to roll over again in the last couple of weeks. So I still think large cap is really the place to go. We did see a little bit of a rotation out of growth into value late last week, as might be expected. And some of that was financials. I don't think energy is going to be the place to be, but technology could experience some real mean reversion, which is what a lot of people have wanted to see for a long time. We've been in a downtrend pretty persistently in small caps versus large caps, I would think, really since the middle part of 2017. So the fact that you get a little bit of a bounce off March lows, it hasn't been significant enough to think that, okay, we're in this big, intermediate term bull trend now for small caps. I think if anything, it's just been a little bounce, and it's really still right to favor large cap value in this case, probably over the next couple months.
Mark, when we go outside the U.S., are there less frothy markets then that can remain more stable if the NASDAQ has this big tech-driven sell-off? I mean, this morning we've got EM only down 1%. It seems like it's a little bit more stable as it didn't explode higher like everything else.
Yeah, it's important to know where you're concentrated there when you say EM. Many of the LATAM companies had lagged substantially and really not moved at all off the March lows. China has been a welcome point of relative safety in recent weeks and months, but now that's also starting to show signs of rolling over a little bit, of course, ahead of this important deadline. So I think the dollar is starting to show evidence of slowly bottoming out on a short-term basis. And so if the dollar can rally throughout the month of September, EM might also experience some pain and really start to pull back. Right now, the charts of EM versus developed markets for me is still pretty range bound. It hasn't decisively broken down to suggest that developed markets are the place to be, or EM. We saw a decent bounce in emerging markets in recent months, and now that's been largely range bound and more of a triangle formation between the two groups. And so I don't have any strong feelings unless I would really see evidence of the dollar starting a larger rally, and that could be detrimental, I think, to the precious metals. Also, if yields start to stabilize, which we've seen a little bit of, yields potentially go higher between now and year end, even though they might have a choppy period while equities fall. But I think the dollar bounces with yields, and the metals should be down, and if anything, that could affect EM as well negatively. So I can't see U.S. markets seeing a technology sell-off and EM remains unscathed and we just continue to go up. I think that it's going to be a broad-based decline. And, the majority of the world indices did not, move up higher than the June highs like the S&P and the NASDAQ did. The broader-based terms, things like the value line, geometric, and many broader-based gauges of U.S. Indices, were not simply moving up every day like the NASDAQ and the S&P. So, it's really still a case of know what you own. And most gauges of like in Europe, the Stoxx 50 or the Stoxx 600, I mean, those certainly have been sort of choppy over the last couple months. They haven't been really hitting new highs. Japan is showing evidence of stalling out. And so we'll see. I don't know about relative safety. I think diversification is more important than ever, over the next couple months, and just being quick to pull the trigger if you're a trader, or, more evidence of trends really deteriorating and seeking cash and, diversifying your portfolio.
All right. Right now we see some of the deterioration, as you point out, in the U.S. market specifically, but those EM ones too. I like the point about how that dollar rush to safety may not be great for that part of the market as well, as EM has basically been sideways now for a couple of months. Appreciate it, Mark. Thanks for the thoughts. Like the technical work. Thank you, sir. Mark is the president and founder at Newton Advisors.